Welcome back to the Keeping the Dream Alive podcast. Today I have the opportunity to sit down with Bill Roark, co-founder of Torch Technologies, to talk a little bit about what valuation means here at Torch. Thank you so much for being here.
Glad to be here.
Yeah, so but to kind of dive into the topic, talk a little bit about what valuation is, maybe a new term for some of the listeners, but what that kind of entails and why it's important here at Torch.
Well, being an ESOP, the valuation is the process we go through each year to put a value on the company shares. We get a total value of the worth of the company, but we know the number of shares outstanding. We can determine a share price so that folks can determine what the balance is in their ESOP account. It's very important. It's a long, detailed process that we go through, and it's done by an independent outside appraiser. We don't get to set that number ourselves, and there's all kinds of federal rules that go around it that we have to follow in the process. But the process starts late each fall as we go into the annual valuation that's set as of 12/31 each year. We go through a long process where they have us sit down and we talk about the previous year's results, what the revenue and profit was for the year we're finishing up and what we expect it to be, and ultimately, before the valuation's done, exactly what it was. But we also talk about the forecast for the company, what the forward-looking pieces are, what the contracts we expect to win new, the contracts that we might expect to be going away or changing. And we go through all that and we build this massive spreadsheet to share all that information with the valuator. And the valuator takes that all into account. He not only takes what we say this year into account, he takes what we said last year and the year before, all those into account, and he looks and to see how well we did on those projections. And the better we do, the more comfortable he is in putting an accurate value on the stock. So we take this process very, very seriously to go through the process and give the evaluator all the information they need to be able to assign the value on the company, and to make sure we do that in a manner that it's consistent with our forecasts so that we get the best valuation each year that's possible, because that's what benefits employees is raising the value of their account.
Yeah. So looking at like maybe the differences between maybe what a publicly funded company versus an ESOP company like Torch is, is there different things that come into consideration when you figuring out the value of that company?
Well, in a public company, so much has to do with the emotion of the stockholders and the emotion of the stock market. So you can have wide swings in a public company just based on, just a few days ago, we had a huge drop in AI stocks because the Chinese announced that they had a new AI engine that didn't take as many computer chips and was very efficient. And of course, that caused everyone to say, "Hey, wait a minute! I need to get out of my AI stocks." And so you had a big fall in the AI stocks. You don't see that much in an employee-owned company where this appraised annually. You basically, in a ESOP, it's like a long-term average evaluation. You look at how the company's doing over the past year and what it expects to do. You take that all into account, and for this 1 day or 2 days a year that you might do, you set the stock value at that time, and it's not subject to the daily whims as a publicly traded market might be. The things that determine value are very, very similar in an ESOP. You know, the revenue and the profit are very important. The forecast, the growth rate are all important. The higher the growth rate, you get a little higher multiple. For the higher the profit, obviously, most of the valuations are multiple of profit. And they'll look at it 2 or 3 different ways and sort of add some of those ways up and weight them and then come up with a value in the end.
Yeah, and it's interesting too, just to like think that, you know, a lot of it is emotion driven for a public company, just with changes in news and stuff like that. And then with an ESOP, it kind of is within the 4 walls, so to speak, of what the company is.
Sort of an integrated position, integrated over time, and it's creates a lot more stability. We also look at this. You look at the public companies. So you did get some influence. You'll look at public companies that are in our space, and you look at the multiples on those, and those become a guideline for what the multiple should be on our
Mm,
valuation. It's a little bit hard to do in our space because there's not a lot of publicly traded companies that are similar in size to us, but we do the best we can, and the appraiser comes up with a list each year, and we look at those and use those as guidelines.
mm. And like thinking back, maybe 5 or 10 years ago when you were getting these evaluations done for Torch, and maybe they're forecasting what the next 10 years. So like basically where we are today, they were
Mhm.
looking at 2015. Is expectations for where you would be today exceeded what the valuation was then, or
Yeah.
is it kind of staying on this like guided path since then?
Well, it's almost always exceeded expectations. I think one or two times in the years the stock market's been down, so the multiple we get may have
Mm,
depressed the stock a little bit and is a little less than we may have thought it was going to be. But for the most part, we've significantly outperformed the stock market.
mm,
Our growth rates have typically it's averaged above 30%. As the company's gotten very large, it's hard to maintain that. So in the last few years, the stock price has grown at about 20%. But those are really good numbers,
mm.
and it's if you compare them to public traded companies, we've done very, very well.
Mm. And so thinking about, this with the formation of Starfish and Freedom Real Estate and kind of all the different parent companies or all the different companies that are associated now with Torch and kind of helps it. How does that kind of affect the valuation, and how has that affected it with, I guess recently Freedom just celebrated 10 years?
Well, all three companies are valued uh, in their own special approach. Torch, is as a services company, and services company typically are valued based on the profit they return, the profit and the revenue that they return, and so it's driven highly by those factors. Freedom Real Estate is heavily into owning real estate, so the real estate itself is valued, and Freedom also has a services component of the business, and so there's a value placed on it and a value placed on the real estate assets. And then that's rolled up to give you a value for Freedom. And Starfish really doesn't have any revenue. Simvana is early and it hasn't been valued independently, but it will be within the next couple of years. But Starfish doesn't really do any business. It's just a holding company. But it does have value in that
Mhm,
there's usually a substantial cash holding inside
mhm.
Starfish. So it's pretty easy to value it. You look at how much cash is in there, and then you have a value. But each of the companies has its own method of getting valued, and then that all rolls up and
Mm.
adds together, and we get the final value in the end that becomes a stock price.
Yeah, and we've talked about it a lot. As an employee owner of Torch, you're part of the real estate. Like you own this real estate too, and vice versa for Freedom. Employees of Freedom are part of this ESOP as well, and they get to the benefits too of what Torch does, and vice versa. There's a lot of overlap within that. As we've talked about it in a previous episode, just kind of the role of an employee owner. What is that role when it is attributed to of getting a valuation?
Well, the important thing is to perform such that we're profitable. To as much time as can be spent on direct labor makes the company more profitable, and the profit raises the value of the company. Be cognizant of expenses that are unnecessary because expenses lower come right out of profit.
Mhm,
So I mean, it's a simple formula. Avoid unnecessary expenses and focus on as much direct billable as you can to maximize the profit. Uh, there's an old story we told years ago about the lights in the building on the when we first bought the building up there. I drove by on one Saturday night and all the lights were on. Well, one of the things we can do to raise the return for the company, then raise the value for the company, is turn all the lights off when we go home, so we're not sending money to Huntsville Utilities that could go in our own pockets,
mm,
and that money stays and becomes income then there's a multiple applied to that. So you're actually the gain in value in the company is probably 6 or 8 times
Mhm.
what you would have spent on the electric bill. So there's big value in learning what drives the return for the company and paying attention to that. Believe it or not, that electric bill's thousands of dollars per month in there. So turning those lights off when you go home at night makes a big difference.
Yeah, and I think as an ESOP, things like that maybe wouldn't necessarily affect directly with a publicly traded
Mhm.
company affect an ESOP. And as the employees are listening to this, being able to think about certain things that maybe are things they don't necessarily take for granted, but things that they don't think about as being a direct correlation to the value of the company, and it can really go a long way in multitudes.
Yeah, and this year's a perfect example. And a couple of years ago, we had the last few years we've made excess contributions into the employee counts in the ESOP because the company's done well and the profits have done well. If we leave the lights on 24 hours a day, 7 days a week, that's money we can't put in the ESOP.
Mm,
So, um, well, not just lights, wasting anything
mm.
from wasting supplies, paper, or having excessive unbillable time. Those all take money from the bottom line and reduce the value, and also reduce the cash that we have to give away as perks.
Mm. Well, I appreciate you being here today. I think, understanding what valuation means for an ESOP, what it means for Torch, though there is a lot of similarities for the a publicly held and an ESOP, there is some unique things that kind of sets it apart.
Mhm.
We'll be sure to have everything in the episode notes for people to find out more information, but I appreciate you being here today.
All right, thank you.